Welcome back. It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back again with Greg Newman, portfolio manager and senior wealth advisor at Scotia Wealth Management. You want to talk about coupon bonds and the ability, perhaps, of clients to save some tax money.
Right. So it sounds like a boring area, but we're all concerned that maybe we could be going into a darker economic period, and it's important to have your asset allocation. And if you're in a registered account, you know what? Why even look at coupon bonds? You can just get a GIC, 6%. That's great. But in taxable accounts, you're paying half to the government, and then part of it's being clipped away by inflation.
Yeah.
So, but if you can buy discount bonds, like a 2-year duration, with an average price of about $92, with a coupon, average coupon of about 1.5, you're only being taxable on that coupon of 1.5. The 92 to 100 that you're going to get over the next few years is capital gains. So it's a way of, on an after-tax basis, getting a lot more return with virtually no higher risk if you're dealing with sovereign bonds and you're dealing with a government of Canada, Ontario, even maybe some corporates, like a basket of those. So it's a really good way of constructing lower risk in non-registered accounts right now.
The key is you're buying the bonds at less than par value, and they will return to par as they mature.
Yeah, exactly. And the smaller the coupon that is paying you and the lower the price that you're paying, they're going to mature at 100. So whatever that price is from, say, 91 to 100, that is a capital gain.
Okay. In terms of asset allocation, you think the setup now for the traditional 60-40 portfolio, 60% equities, 40% fixed income, is pretty good?
It's better than it's been in years. And, it used to be that to get a 7% return in a 60-40 portfolio, you had to do 12% on your equities because your bonds were paying 1%. So 7% doesn't sound very good, but if you're really 60-40, your equities were working pretty hard. Now, if you got your fixed income sleeve paying 6%,
right,
your equities don't have to work so hard. And you happen to be in a period right now where you have all these great dividend stocks in the TSX that are throwing out 5 to 8%. And so if you can do some good stock picking, you got your 6% fixed income sleeve, you got your 5 to 8% from the dividends, and you don't really need that much from the capital appreciation part to have a nice and pretty picture going forward. So I think the 60-40 setup is better than it's been in several years.
You mentioned the dividend payers, and they get a lot of attention from investors these days. And on this program, there are a number of very high-quality dividend payers with pretty high dividend yields because the share prices have come off somewhat. Do you recommend clients have exposure to names like BCE, which again is the parent of this channel?
Yeah, you know what? Yes, the general answer is yes. But you want to be discerning. The devil is in the details. The dividends are great. Look at the dividend growth, look at the earnings per share profile, anticipated return over the forecast horizon, and look at the price to earnings and look at the price to growth. So some of those you don't want to really be owning, but there's great names in there that are very compelling, like an AltaGas that, is growing at around maybe 10% with a PE of around 11 times, for example. Within those energy infrastructure names, there's some that are more compelling with others. Within the banks, they're starting to look more compelling. Within the insurance companies, there's some. So yes, but you don't just want to look at the dividend.
Two of the classic dividend pairs in Canada, TC Energy and Enbridge, both yielding now well more than 7%. Enbridge is on its way to an 8% yield.
Yep.
TC Energy is at 7.4.
Well, this is because these were over-owned as bond proxies, and as people were able to get 6% on GICs, they started to own less of these. TC Energy is cheap. It's 11 times earnings. Enbridge isn't so cheap. It's about 14 times earnings. TC Energy has no growth for the next little while. Enbridge has some growth of about 6%. So you have to ask yourself which of these are the better deal, and are either of them as good as an AltaGas or a Keyera right here.